Good morning, everybody. My name is Richard Angus. I'm Head of Business Development at Hardman Co, and I'd like to welcome you this morning to our latest in the Private Company Valuation Hardman Talks series. I'm delighted this morning to be joined by two individuals. The first is Doug Lawson from MarktoMarket, who's been with us before. And then we have our special guest today, who's David Battey from Lumaca Capital. And I'll be discussing what he's thinking later on. So before we talk to Doug, the key thing to remember here is that this is an ongoing series because we think there are a number of trends in the market that people need to be aware of, the factual trends, that are also sentimental trends. And that's why we're holding this series on a regular basis. And if anybody has any input afterwards, it would be gratefully received. The other point I have to make is that nothing should be construed in this discussion as offering investment advice. This is an information-only series, nor are we trying to suggest that people take a course of action. So having said that, now I think I'd like to hand over to Doug. Doug, good morning, and we look forward to your update.
Morning, Richard. Thanks very much for having me again. I just want to go through some of the trends that we're seeing in the market. But before that, if I could just explain a little bit about MarktoMarket to set the scene. So we are a data provider, and we're used by corporate advisors, accountants, people working in private equity, corporates, wealth managers, corporate lawyers, basically anybody that wants high quality data on the private markets. And we have a particular specialism in the small and mid market, where data is, I think, much harder to find. We're based in Edinburgh. We have 33 people, and we are venture capital backed. So the type of thing that customers will use our database for is to value businesses, to find buyers for their client, to originate deals, to do market mapping and so on. But valuation is absolutely a key part of the platform. So if we just start by looking a bit at deal activity, and I think it's worth saying that when we think about deals, when we think about the market, we really split it into two verticals. And the first one is M&A, so that's businesses being bought and sold. And the second one is fundraising, so that's businesses raising fresh capital. So first of all, if we look at volumes for M&A, and we just look at 2025, and I will put this into context, but this is the picture. This is the monthly picture. This time series goes back 13 months. You can compare December 25 with December 24. This is the number of deals involving a UK party. So we've stripped out international deals from this just to give a UK picture. So this is by month the number of mergers and acquisitions transactions completed that involve a UK party. And you can see it kind of trends around 450, 500 per month. You do typically see some seasonality here. The weighting of businesses sold are obviously towards the smaller end of the market. You know, the highest volumes are the smaller deals. A lot of those deals will be owner managed businesses, and some of those transactions will be driven by actual or perceived changes to tax regimes, capital gains tax principally. So particularly in the last few years, we've seen a bit of seasonality in the market and elevated levels of deals being completed as the tax year end approaches. So in March and very early April, and you can see that impact here. The two most active months of the year were in March and April. And then sometimes you see a bit of a build up towards Christmas, deals getting done before Christmas, and then a slightly quieter start to the year, which is what we saw last year. Now that's the year in isolation, 2025 in isolation, but how does that compare to previous years? So this chart looks at annual volumes for 2025 on the right hand side and compares it to the last 5 years. And actually, I think there's been a lot of rhetoric, a lot of press attention around weak deal flows, weak M&A markets, and we're not actually really seeing that. So I think what is happening is deals are taking longer to do. I think any advisor you speak to would agree with that. But in terms of the number of deals being completed, it's still pretty healthy. The market is still quite healthy. On this chart, maybe it doesn't look that healthy because we're comparing it to a couple of years that were definitely outliers. If you look at the longer term trend here, 4.5, 5,000 deals is about right if you were to roll back before 2020. But we had this exceptional level of activity in 2021 and to an extent in 2022 as well. So maybe but if you look at the last year in the context of 24 and certainly 2023, it was actually pretty good. It was pretty good. This is flipping over to fundraising, and it's not an entirely dissimilar picture. So I think again a lot of noise around weak markets, but actually we're seeing a lot of deals getting done. Now the devil's in the detail here. So we don't have time for this, but we also split the market into pre-seed, seed, Series A, and so on. So if you were to look down into the detail there, you would see different trends in terms of the different areas of the fundraising market. But when you look at the market overall, the volume of activity is still pretty good. Again, 2021 and 2022 were exceptionally strong years. But actually 2025, if you look at long-term trends, was actually reasonably good. So that's the kind of deal volume picture. If we now flip on to the valuation side of things. So what we do when we're collecting deal information, we also do an analysis of the pricing of the deal, and that could be quite a complex thing. You may have to look in multiple different sources, multiple different documents. That information comes out over a period of time. It's not sort of nicely presented on the day that the deal is done. But over time, you can build up a picture of what was paid for a specific business, and then you can aggregate that data and you can come up with some conclusions about how the market is trending. And one thing that we do is we produce quarterly indices for our customers, and we call these the MarktoMarket indices. So these are like the FTSE indices, but specifically for the private markets and deals happening in the private markets. This is our all cap index. And because we focus on the small and mid market, our all cap index has a cutoff at £250 million enterprise value. So the deals that we put into these buckets, into this specific bucket, will be deals from a few £100,000 all the way up to £250 million. So as I've said before, devil's in the detail, but I think this gives an interesting view of the trend. Now, this is provisional data. We haven't released our 2025 numbers yet, so this could change. But what this is telling us is that if you look back to 2021, 2022, multiples are some way off where they were back at that period of time. We saw last year a bit of an improvement. So multiples fell from 2021 at these are EBITDA multiples, and I focus on the median multiples. So those are the big numbers there that we're looking at. It was 7.9 times EBITDA was the median EBITDA multiple in 2021. That fell 7 times, which fell 6 times in 2023. We saw a bit of an uplift in 2024, but there seems to have been a bit of a compression in 2025 as well. These numbers, you're always, an important thing to say here, and a key difference between our indices and the FTSE indices is that what we're doing is we're collecting all of the deals that we can get information for that happened during that specific time period. So the cohort of companies is not the same from period to period. So sometimes what's going to happen is your multiple is going to be influenced by how many small deals there were relative to large deals, how many tech deals there were relative to industrials deals, for example. Some sectors will have higher multiples, and typically the larger the deal, the higher the multiple. So we always caveat these, but our sample sizes are pretty big, and I think this kind of high level view shows the trend has been not actually particularly positive year on year. This is looking at revenue multiples. It's probably of secondary interest. Similar story here, compression of revenue multiples from a high of 1.4 in 2021, 2022, down to this 1.1, 1.2 level. This is quite useful for companies that maybe aren't profitable or have suppressed profitability or whatever. As well as doing our high-level indices, we do our size indices. So what we do here is we bucket the companies into size bands, and we have our nano cap index, our micro cap, our small cap, mid cap, and large cap. So you can see on the left-hand side of this chart, the 6 times, that's the all cap index multiple. The nano cap index is businesses sold for under £2.5 million. And the median EBITDA multiple there was 3.4 times. Once you get into 2.5 to 10 million, the multiple increases to 5.4 times. Small cap, 10 to 50, multiple goes to 7 times. And then mid cap is 9.3 times. Again, provisional data. But this shows very clearly the impact of size on multiples and the fact that you would expect multiples to expand as deal sizes increase. Diving in a wee bit deeper, so I've just done a little bit of analysis on some popular sectors at the moment. So we were looking at when we were looking at those size indices before, that takes into account businesses across sectors. What you can also do on the platform is you can drill into specific sectors and look at how size influences the multiple. This is the TIC sector, testing, inspection, compliance. Very popular at the moment in terms of buy and build, pretty high volumes of deals going through, mostly by private equity-backed vehicles. And again, you can see this multiple arbitrage being played out here. So the idea is for these private equity-backed vehicles, you buy a platform business, and that platform business might be in the sort of lower mid to mid market. It might be a £50 million deal. It depends, of course. But then crucially, what you then do is it's a fragmented market and you're picking up smaller assets at the smaller end of the market around this nano cap or micro cap end of the market. You buy those businesses for lower multiples, you bolt them into the group, and you get that earnings enhancement from bolting those onto the group, and you get that multiple expansion. So that's kind of the classic private equity buy and build story in the TIC sector, very clear there. Another one that I looked at is logistics. Exactly the same story there. So you could see multiples expanding from 4.1 times median EBITDA at the nano cap end of the market to 8.7 times at mid cap, and moving up to 9 times and 10.3 times at large cap and mega cap. Just some recent deals just to conclude here. So these deals have all happened over the last month. I think what's interesting here, if you look at the mega cap deals up at the top there, you can see what happens to multiples at the top end of the market, particularly when it's a tech company or a software company. So you can see that actually the second business there, OneStream, that was a private equity buy by HG Capital. It's £4.7 billion pound deal. And the revenue multiple was just under 11 times for that business. PA Consulting Group, that's a professional services firm, over 13 times was the multiple there. We're seeing a lot of activity in professional services, and for big professional services groups, particularly accountancy firms, 15 times EBITDA is not an uncommon multiple. Then if we move down into the small cap, micro cap, and nano cap, so we've got a consultancy business that was acquired, a business called Pearson Ham, quite an attractive multiple there, 12 times. I think that was quite a data-focused business, which would definitely have helped the multiple there. To the right of that are a couple of lettings agents. Those were valued on revenue multiples. So this is an area of the market where revenue multiples are very relevant. Strong underlying recurring revenue businesses typically valued on a multiple of revenue. Those businesses, the buyer paid 2.1 times revenue for one of those and 2.67 times for another one. And then we have down at the micro cap end of the market an engineering business, which was sold for £8 million, which was a 4.8 times multiple, very typical of businesses at that end of the market. And then a and then a lowly security business down in the nano cap end of the market. That was a very small deal, and that was just over 2 times EBITDA. And I think that's maybe not untypical for businesses of that kind of size that are operating that have no real competitive advantages. You'll see very, very low multiples being paid there. So just in terms of trends, our customers on the advisory side are telling us deal timelines are still very long. Multiples are being determined by business model as much as sector. So if you have strong underlying income, contractual income, irrespective of the sector that you're in, that's going to impact your multiple in a very positive way. We're also seeing multiple expansion in some specific sectors, particularly those that are very popular with private equity at the moment, because what they're doing is they're using their platforms to go down and buy up very small businesses in fragmented markets. That's creating more competition and pushing multiples up, which is this point about the buy and build models here, which are bringing small businesses into the crosshairs of private equity. This is just a notice here, which I'll leave on the screen, and I'll just say thank you very much, Richard, for having me.
Well, Doug, thank you very much indeed. That was a fantastic summary of where we are and the data from 2025, which I think people will find incredibly useful as we're moving forward. So now I'm going to move over and talk to David Battey. I think it would be a good idea to start off with by just explaining who you are, what you do, where you've come from, and then what we'll do, we'll have a discussion about what you're seeing in the market as well, and tie that in with what Doug's also told us already. And then what I think we're interested in is whether you see any specific trends that are emerging, or whether 2026 is going to be as challenging in some areas as 2025. But as Doug said, it wasn't as bad as some people might have thought it was. So over to you, and I'll catch up with you when you've just explained a little bit about what you do and who you are.
Super. Thank you, Richard, for the invitation. So I run Lumaca Capital with my partner. There's two-partner investment advisory business focusing on investing and advising businesses approaching their first institutional capital round. Our backgrounds are broadly similar: professional services, private equity, hedge fund, and family office on the portfolio side. And we came together two and a bit years ago to invest and advise businesses and build a portfolio for our investors at late seed, as we saw that as being the most attractive part of the market to invest in, but also one of the trickiest parts of the market to get right. We look for companies that essentially are approaching profitable scale but aren't quite there yet. We help shape them towards their first true institutional round, which tends to be that Series A large round, or it could be a pathway from when we come into exit. We run a cross-sector portfolio, and we're pretty hands-on investors.
One of the things that the market has been concerned about for some time is that the corporate world in the small cap, very small area, hasn't necessarily communicated with investors appropriately, or vice versa. The investors don't really understand what the companies are trying to achieve, and that's a communication problem. And like all markets, unless you get buyers and sellers in sync, you won't actually get something happening. Do you feel that when you talk to some of the potential investments that you're considering, that the entrepreneurs or the owners of these businesses actually talk a language that you can understand and you can basically then translate into, shall we say, English for your clients, or not? Or do you find there's still a bit of a struggle in terms of that establishing that link?
I think it tends to be a bit of a mixed bag. We have certainly two or three in our portfolio, the founders in our portfolio, who are very, very strong at reporting, sometimes too communicative in some ways, but essentially they're able to keep the investors informed of what's going on a fairly regular basis. I think what we tend to find with our investors, the LPs behind us, is that we are pretty embedded with the companies, so they can actually pick up the phone to us, understand what's going on with each of their investments, and that tends to be how we operate. We work on a weekly call basis with each of our founders. We coach them in terms of how they're going to grow their team, how they're going to step back from their business as a business scales. So if we're not getting the right information back from our portfolio companies, it reflects poorly on us, let's say. But our LP should understand from us that they can pick up the phone and we know exactly what's going on. And it's critical, really, that we have that level of understanding, given the challenges that we find with these companies as they approach scale, because they're still trying to find their path towards true scalability. And that could be, really finding product market fit, or there could be different channel challenges that we have to overcome to make them investable further down the line. So we tend to find more communication is better than less, and that's something we impart upon the founders that we work with.
Okay, so one of the topics that I'd like to discuss with you is the importance of liquidity, because when we're in a blue sky economy and companies are growing and investors are looking quite a long way out, no one seems to think there's ever going to be a problem in raising more capital in the future, and it's just a question of how quickly a company can grow. I would say that looking at what happened last year, that has not been the case, and that good companies can fail because they run out of money, or they just basically have to slow down to such an extent they get overtaken by competition. So where do you think access to liquidity fits into the equation for 2026? And if we were here a year ago, would you have the same opinion, or would you have a different opinion about where we actually are in terms of funding these businesses and where they can actually get the money from? And what I mean by that is, do companies go back and get money from their existing shareholders, or are they desperate to find new sources of income because existing shareholders have said, look, we've reached our limit, so to speak?
So if we look at the typical avatar of a business that we work with, they tend to have gone through one or two rounds of financing. So they might have done an early SEIS round, which is generally fairly loose capital and easy capital to raise, and valuations sometimes don't make much sense. They might raise a further round from that existing pool and get some further external capital then, but then they're a bit stuck because most of their shareholder base has felt they've done enough. But the barriers to getting institutional capital at Series A have moved quite a long way to the right, and there's still a long way to go to get there. So the investment that we put in, which tends to be somewhere between £500,000 to £1 million per deal, we want the business to get to profitability, which gives them options to get liquidity at some point further down the line. So we're not going back to our investors to ask them for more capital. So that provides them natural diversification. It takes them risk away from the investment case. And it means when we go and talk to Guinness or another one of the VCTs or VC firms, we're doing that from a position of strength. And that's fundamentally important. I think the way we look at liquidity is we're aligned on an exit. Our fee model essentially is a 0 and 20 structure. So we have a heavy operational focus. We focus on the exit. We want to work with founders that have a view on an exit, and we have a clear pathway on the operational and kind of corporate finance journey to get there. I think without having that, it's very hard to invest behind an entrepreneur who may want to raise 4 or 5 rounds of financing to get to their exit. And that's why I think we're a little bit different in how we approach the market and how we think about liquidity and how we think about exit. And we're fully aligned on, the only way really we get paid is when these companies are successful. So that's our driver.
So if we'd been here a year ago doing the same interview, would you have said anything different from what you've just said? Do you think 2025 had stumbling blocks in it, despite the stats that Doug's given us? Or do you think basically when we look for 2026 that life is going to improve in terms of getting more activity? And I say that because last year seemed to be in many cases a year of indecision, inactivity, inertia, but lots of people are waiting for whatever it is they need to do on the investment side, and they need something to make them do it, as opposed to leave it another month or two. But companies are 24/7 operations.
Yeah, and I think if you look further back, to 1920, through COVID, and the amount of funds that were raised and the amount of companies that were formed at that time, you're inundated in a fairly benign interest rate environment with opportunities to invest. Now they all come to a point where they need to get institutional capital. But that institutional capital, I think, is being squeezed. So if you look at the changes to VCT rules this year, that is going to have a knock-on effect on the ability of these companies to scale up, and that's a little bit short-sighted. If you look at the long-term return on venture generally, the median IRR on venture across the UK from 2005 is 4%. Now, if you want more pension funds to put money into venture, that has to change, because why would you not just put it in long-dated gilts or discounted gilts and do that? Is cheaper, better liquidity. If I think about last year, we had 4 months at the start of the year, which was basically Trump and tariffs, and then we had 4 months leading into a budget which was, sold as being everything is terribly bad, and we don't have that this year. So despite the changes to VCT rules, I'm a little bit more hopeful. But it is only January, and I know these things kind of change on a weekly basis. So.
And do you have a feeling about any particular sectors or areas of the market that are more interesting than others? And one of the things that always interests me is that when transactions take place, whether in fact somebody is desperate to find some funding from an investor, or in fact whether there's any investor competition in order to participate, in which case obviously that has an influence on valuation.
I think generally we are, I wouldn't say proudly cross-sector, but we think cross-sector is the right approach for us generally. We had a little bit of nervousness last year around the bubble in technology, and I'm not quite sure how that plays out over the next kind of 12 months or so. We see some very interesting kind of subsegments of the consumer sector. So the affordable part of the market and the high-end part of the market, they've always been good areas, I think, for investment, but we're seeing some very interesting plays in leisure at the moment. So I would say we will continue to keep an open mind in what's attractive in any sector, with a view that we have at the moment within our portfolio 3 technology companies, 2 consumer and 1 leisure. So we have to be mindful of what we're building for our LPs in the background to give them that true diversification.
Okay, I'm going to just have one more question, then maybe if Doug, you have a question or two, then that would be a great time to come in. When you're looking at companies and their business models, do you actually find that many companies produce reasonably sophisticated, I would say, business models, or are they not really that good at planning ahead? They can see the immediate future, but when you're an investor, you want to see it a little bit further than the next 6 to 12 months. Do you find that some of these companies are better than others at sort of identifying the opportunity in the longer term, or do you think they go from year to year to year in terms of let's see how things go?
So I think the way that we approach this is slightly different. So we like to be with our founders, either advising them on a paid basis or an unpaid basis for quite a few months before we invest, and that means that we're helping them shape the business plan with them. And for our perspective, we need to see a minimum kind of 5x return on our money. So we are looking to see whether the business plan will support that, and actually how we build value over the near and medium term to get to that inflection point. So it's a collaborative exercise. We are very mindful of the fact that the entrepreneurs that we meet are really, really strong in what they do, but they're not fully rounded, because people just aren't. And a lot of the time in the brand facing businesses that we work with, financial modeling and those type of things is not their skill set. So we support them in that, and we help build the picture which supports the narrative around the brand and the brand building exercise they need to go on. So we're pretty clear on what certainly the next 12 to 24 months looks like. And from our perspective, that's the key risk area for our LPs, is that we put the money in and they may be approaching profitability, but they're not quite there yet. We have to get to that point. We have to find a way of getting to that point with the right growth trajectory, and that's a joined up exercise.
Very interesting. Thank you very much. Doug, do you have any questions?
Yeah, I think something I'm interested in, David, is that it's all very well looking at the headline stats to see valuations, and maybe that when we've been looking at that, it looks like valuations at the early stage of the market for fundraisings, and by early stage I mean sort of pre-seed, seed type stages, have been relatively well supported. But I wonder how much of that is being masked by structuring, and are you seeing an increase in structured instruments being used to either protect downside or enhance returns?
I think if we if we think about valuation from, I guess, from our perspective, that's frankly the biggest challenge we have. Because the founders we come across tend to have had a fairly interesting ride in terms of raising capital, but also the looseness of capital caused by the kind of SEIS and EIS market. So the thinking around valuation from our perspective is actually, well, what does the valuation need to be now to show that valuation uplift when we do talk to institutional capital? I think it's fairly common that the type of funders we may want to talk to for follow-on capital will look at things like pref shares to protect their returns. Some are more aggressive than others, and I think that's just a function of the market. I can't really bemoan it. It's just it is what it is, but it doesn't feel fully aligned to us with the founders that we work with, and we prefer to find funders who come alongside us, more patient capital, kind of private capital, that are more aligned on the cap table, that just fits better with our model. So yes, I mean, I've seen some fairly horrific terms on liquidity preferences and things like that coming through at A and beyond. They do protect the fund in a downside scenario because, frankly, it's very hard to hit the financial forecasts you present to anyone. It just doesn't happen. When I was looking after a portfolio of 35 companies that were kind of mid-market and above, I think one of them hit their 5-year plan, and that's just their established businesses. So it just doesn't happen. You just need that understanding, and you need to not have that hanging over you, I think, when things go wrong.
Yeah. Interesting. Thank you.
Well, gentlemen, I'm afraid we have actually run out of time. So thank you both very much indeed for a very interesting discussion. To our viewers, we will be holding more of these private company valuation Hardman talks during the year, probably on a quarterly basis to keep everybody up to date. So thank you very much for your attention today. If you have any comments, would you please let us know, because we're always interested in improving our communication. And thank you very much, and goodbye for now.